I guess we can start. So thank you very much to everyone for coming to our session. So my name is Davide Castellani. I'm an academic and consultant in the field of financial inclusion. I'm also co-head of the action group of From Research to Practice of the European Microfinance Platform. So I'm co-heading the group together with Max Nino Sarasua, who also contributed to the organization of this session. So our journey started about 3 years ago, a journey into financial health. We decided to embark on this journey because we believed that there was a gap that needed to be filled in terms of understanding what financial health is about, measuring financial health, so what are the components and how to measure them. And starting from the last year, we started working on the business case for financial health. So does it make sense for financial institution to focus on a client financial health? For sure, yes, right? But the answer is a bit more complex. So it's also about what are the institutional benefits. So is also the financial performance and institutional performance of FSPs benefiting from taking a financial health approach. The last year, we had also the opportunity to discuss about the business case of financial health in another session here. It was much at a higher level, so talking about by, taking a much higher perspective. This year, we decided to go into the field and to listen the voices from the field. So we have today the pleasure to have with us some different speakers. A couple of them are in person, a couple of them are in distance. I will introduce them in a while. But let me tell you very briefly what the business case is about. So the idea is that in order to have a business case, first of all, we need to have a corporate, so to integrate financial health into the corporate values, to designate a financial health team, to measure financial health, and going from measuring to adjusting processes, products, services, or developing new products and services. We need to also establish client protection procedures because we want to avoid, negative consequences on the clients, especially regarding, for example, over-indebtedness and other similar issues. And then the last step is to link financial health performance of clients with the financial health, let me say, of the institution. So this is the very last step. However, there are, can you start the presentation, please? There are, however, some challenges because this is very beautiful, but this is theory, right? And so in practice, there are several challenges that we need to address. So first of all, it's about measuring. So measuring can be very challenging, complex. And then another challenge is how to translate the insights from measuring financial health into practical solutions, into practical strategies. The second and probably even more important challenge is cultural resistance, institutional resistance, the resistance of clients of adopting new financial behaviors. Thank you very much. Okay. Enhancing client engagement, financial literacy is key for financial health. So improving the financial knowledge of clients. how to balance customization of products and services with scalability. And then there can be also other constraints such as financial resources constraints, human resources constraints, and last but not least, regulatory and compliance barriers. Okay, now I want to leave the floor to our guest. So let me introduce them very briefly. So we have the pleasure to have in presence Stephanie Garcia Van Gol, that is the head of impact at BBA Foundation, Microfinance Foundation. Benjamin Mazzotta, that is a researcher and consultant and at BFA Global. Then we have the pleasure to have Meda. Meda is the CEO at Microfinance Foundation. And then Angel Andres, that is marketing manager at Cooperativa Cremex in Mexico. Okay, I want to start by asking you, Benjamin and Stephanie, a preliminary question about your institution and about why is client financial health relevant for your institution? Who wants to?
So for those that don't know us, we are a microfinance group that operates in Latin America. We have 3 million clients and over 1 billion portfolio in asset management, managing assets. We've got about 8,000 employees. Latin America, thank you. Colombia, Peru, Dominican Republic, Chile, and Panama. And of those institutions, 3 are deposit taking, so they're banks. So they're able to provide any type of saving product. The other 2 are not able to. So mainly when I refer to saving products, I'll refer to those institutions. Just to give an idea, some of you may know our institutions. It's Banca Mía in Colombia, Financiera Confianza in Peru, Adopem in Dominican Republic, Fondo Esperanza in Chile, and Microserfin in Panama, to give an idea. Why is financial health important for us? Well, financial health is the intermediate outcome to development outcomes. So definitely, and there has been a case to prove why resilience and some other elements of financial health are important to improve outcomes for our clients. We've done a number of studies in financial health over time. Maybe I'll get to that a bit later, no? Yeah.
Hi, I'm Ben. I'm here on behalf of BFA Global, and financial health is a major practice area for us. We've run projects in several different geographies with microfinance institutions and similar types of institutions in Mexico. I think many of you will know that financial cooperatives differ significantly from microfinance institutions, but nonetheless, we've been interested in demonstrating what are the techniques that allow us to measure financial health, what are the interventions that can improve financial health, and in what ways can either product or strategy for the financial institution and the financial service provider be tied to measuring financial health. In terms of why it's important to a financial services provider, we like to think of a 5-part business case for financial health. Number 1, we need to be able to measure financial health cost effectively. What we can't measure, we can't manage, we can't direct resources toward, we can't make progress on. 2, we can think about financial health as a tool for segmenting customer populations that might have similar interests, needs, and challenges, either with regard to products and services or other interventions that wrap around those services. 3, it allows us to provide better advice to individual clients and to tailor the services that they might want to ultimately acquire through the financial institution. 4th, it's an important management tool to see whether or not programs, tracks, and different portions of the institution are on track to achieve their goals. Finally, we're really committed to this idea that measuring financial health is an important brand building tool. It's a strategy that's been implemented very well in some markets by some financial services providers, where they're able to strike up a different type of relationship with a customer by making a firm commitment to comprehensively measuring financial well-being not just uptake and profitability of specific products. But these strategies have challenges. And I think if you go to different parts of the ecosystem and ask what financial health is, or even another word that's often used to mean the same thing, financial well-being, what is that? You'll get different answers from different players in the ecosystem. You'll see multiple iterations of financial health and well-being research done in the same geography, sometimes by multiple public sector organizations, and sometimes by a combination of public sector organizations, private sector, and the third or nonprofit sector, who are all thinking about financial health in slightly different ways. And I think even within the global third sector, you'll find some real push and pull between the specificity of a measure for one geography and the kinds of metrics that are more similar to, for instance, the World Bank's Global Findex, which would allow you to make comparative statements about financial well-being in different markets. And the more sort of portable and well-traveled the financial health metrics are, the greater is the risk that one set of questions or data points from one market and one financial institution are hard to translate on the ground at the very last mile where data collection is happening. So we have a lot of different types of practice in this area. We have a lot of opinions about how to do this work well, and we've been in touch with many of the leading organizations that develop metrics for one purpose or another that go under this very, very large umbrella of financial health. And I just wanted to point out that one of the FSPs on the call today, Academics, is a longstanding partner of BFA Global's. They've been a multi-year partner in our FinSalud project in Mexico. We're very, very happy to have them with us today and to share what they think have been the fruits of this work together. Thanks.
Thank you very much. One of the key aspects of the financial health approach is measuring. Measuring is complex. We talk about, different views about what financial health is actually, and it's costly, and what are the benefits about measuring financial health. So my next question is about what has been your experience in measuring financial health? Can we leverage on some existing data that we already have inside the institutions, such as transactional data, and how we can go from the data we have to products and services? So the word to you, Stephanie, or do you?
I can go first, yeah, I'm happy to go first.
You go first.
I love talking.
Okay.
So I have this one slide, and, oh, is it up there? Did I screw it up already?
No.
I was back before.
Yeah.
There, okay, much better. Sorry about that. So this unfortunately is in Spanish. My apologies for that, but much of our work in financial health is in Mexico. But it actually very sort of by accident as much as on purpose lands very nicely in English as well. So this DORA acronym that's up on the board is a set of signposts for concepts that are common to financial health measures, regardless of which institution you go and ask, what does financial health mean? What are its parts? How do I measure that? Regardless of whether they're using survey tools or whether they're using data directly from financial services providers, that's MIS data, or some other source of data about the subjects of measurement, almost always you find that there's a four-part framework for financial health. And in English, we refer to these as day-to-day, opportunities, resilience, and agency. So by day-to-day, we mean that the individual or the household or the small business that's being measured is able to manage their obligations. They're able to smooth expenditures from available sources of income that all too often are unpredictable, volatile, and seldom enough for their intended purposes. By opportunities, we mean making plans for the medium and long term, able to realize financial goals that you set for yourself that are realistic and that we're able to measure in the present in some sense that progress is being made toward those goals, tangible progress toward achieving financial goals in the future. So if you were to look at, for instance, the Australian framework, you'd have every day, one day, that's the someday, opportunities, and then you'd have a rainy day fund is almost always a part of a financial health framework. So for us, that's resilience. We think about the ability to manage or react to a shock and come out on the other side using a wide variety of different financial tools and services, some of which are formal and some of which aren't. But nonetheless, the framework for financial health needs to touch on these four aspects. day-to-day expenditures, opportunities for the future, resilience, and finally, agency. And by agency, what we're getting at is a subjective, well-founded sense of control over one's financial life. I understand the products and services that are available to me. I know where to get help. I know how to analyze those products and think about which ones are a good deal, which ones are a bad deal. And I'm not overly stressed about financial affairs. So the subjective component and the educational component of financial well-being or health is under that fourth bucket, DORA. If you look to major frameworks around the world, you'll almost always see those four components show up in one form or another. For us, what we're looking for is ways of measuring today that predict future well-being and that are not one-to-one identical to the behaviors, concepts, and frameworks that we're promoting. What we're really looking for is early signals about how opportunities will be availed in the future, how shocks will be born in the future, and whether the individual is able to sort of in the general broad averages get through most of their monthly or annual predictable payments that they need to make. But we don't have the luxury of waiting 3, 4, 5 years to see what actually happened. We need actionable information now, and we're trying to use it as a way of measuring whether the products, services, and behaviors that we promote, that is, have an account, put some money in the account, a transactional pattern of using that account, an educational program that goes along with your first account, incentives to make regular deposits at a specific time that's tied to the repayment of a specific loan product. Whatever the interventions are that we're advocating, even something as simple as a household budget, we don't want to use our financial health measurement framework just to check for compliance with the tools that we promote in whatever sense. We'd like for those to be different things so that when we're done with an initiative or a marketing campaign to advance uptake of a particular product or using a product in a certain way, we'd like to be able to show that there's been an improvement in well-being that results from that product uptake or another intervention like it. Does that consign us to the world of always doing surveys? No. Does it consign us to only picking tools off the shelf that have been pre-approved by leading players in the industry? No. For many institutions, choosing a framework that is nationally benchmarked, that is ready to go, that's already had the calibration studies done, a survey is oftentimes sort of the easiest entry point into measuring financial health. And we would recommend that most FSPs that want to measure financial health start there unless they have another nationally recognized way of doing research on financial health. However, if the tools that are available are not nationally benchmarked and are tough to translate into the local language and don't make sense to your client population, because their financial context is different, the types of services that are available to them are different, it may make sense to use a different question set. And in some settings, we find that the interplay between administrative data, that is just some rough ratios about the uptake of savings accounts, ability to pay debts on time, debt to asset ratios, those things can all be informative. We at BFA are also pioneering some fairly data-intensive metrics where we use algorithms to study different transactional patterns with deposit accounts at the same institution and look to see whether the way the individuals are using their deposit accounts can be married with a little bit of survey data to provide sort of a stereoscopic view, a little bit of observational information about financial health and a little bit of subjective self-reported information. And I don't want to tip our hand too much because I think later on we're going to get to some of the challenges in measurement, but I will say that these tools that we've put out into the marketplace, we've tried to work with an open core business model, meaning this other brand that's up on the screen behind me, SEMA, is the product of a design sprint and a calibration study that we did in 2021 and 22 in Mexico. So we developed a question set for Mexico for the members of financial cooperatives there that we thought got straight to the heart of financial health We used a very large survey to ensure that we knew what the question set that we had for financial health was telling us about financial health. So we were very confident in our scoring metrics. And we built that into an open source tool, SEMA.lat. You're welcome to take it out for a test drive if you want. It's intended as a business-to-business tool where FSPs can take that set of questions that we calibrated with the members of financial cooperatives and launch that survey with their own members. It's plug and play, it's ready to go. And because we're keen on sharing that intellectual property, that's the questions and the scoring algorithm that goes with it, we've also had several fintechs in Mexico that are now building that same set of questions into their own apps. They're repurposing those questions and the scoring algorithm so that other fintech apps can have a measure of financial health that goes along with what they're doing. Unfortunately, we were earlier into market than the national survey and SAFI was. So going forward, I don't know how long SEMA will live, but right now SEMA is in the marketplace. It's doing great. People find it very intuitive and they're embedding it in other products. We're very optimistic about that for right now.
So to add to the more global view, I'll bring it down to a microfinance institution. So we, in our framework, we use 3 of the words of the DORA. We use the day-to-day opportunity and resilience, but we've slightly changed that framework to our own. So basically what we have is 3 levels. So management, do you manage your expenses on a daily basis? Are you able to cope? The second part would be, are you able to cover shocks? So emergencies, are you able to manage those on a regular basis? And are you able to plan for the future? So this is similar to what BFA has told. But really what we're trying to understand here is how the household manages their finances. And this is pretty important because we fund entrepreneurs, only micro-entrepreneurs. And so this means that through our surveys, we're now trying to add information on the household and trying to understand how the household manages their finances at a broader level. So I'm going to share a couple numbers just to give a bit of context at where we're standing. Again, Latin America, micro-entrepreneurs, average loans about $1,200 roughly, so you have an idea. Mainly women, 30% rural, 61% women, just to give an idea, right? A typical microfinance network. So when you look at the numbers, if you look at household income, it's pretty unstable for half of them, right? A little bit less than half of them. Unstable means that they're not able to have a monthly income from their business. The business tends to be the main source of income of these households for 12 months in a year. They generally have income for less than 9 months of a year. Let's say a pregnancy roughly, right? When you look at expenses, most of them are able to cover day-to-day expenses. A very small percentage, 5%, do not cover day-to-day expenses. We've done this survey again this year, and it's funny because in countries that are doing pretty well, like Dominican Republic, that's growing, this has changed this year. But basically, on a day-to-day basis, they cover expenses, and they can even cover a little bit more in some of the other cases. So, for example, beyond day-to-day expenses, you can cover contingencies, or you can even cover everything, which would include leisure or even have the ability to save. If you ask our clients if they have the capacity to save, all of them, and we've done surveys for the last 5 years, all of them, which is 90% of our clients, would say they'd have the capacity to save because on a day-to-day basis, they always put some money aside, some of it. So you do have that positive intention in the short term. When you look at the longer term, things differ. So if you look at, in the longer term, how things progress, if you look at their savings balance, and we looked at this as the number of months that you're able to survive with your savings, you'll see that only 34% can live over 6 months. So that's the average balance that you would have in our segment, right? If you look at assets, however, it's slightly higher, 64%. This, of course, differs across countries. This is average numbers. This is for all our institutions. If you look at a country like Colombia, for those that know Colombia, the situation has been pretty bad over the last couple of years. High inflation, a lot of shocks, a lot of climate shocks, a situation that's very, very uncomfortable politically as well. These numbers are much, much lower. A country like Dominican Republic that's been growing, the entire country has been growing. The system is very stable. There you can see that the other side, let's say the 34% is slightly higher. But generally what's interesting here is that rather than saving, and we can talk about resources, that's another conversation, a lot of clients, especially vulnerable clients, tend to invest. And there's a mix of concepts between saving and investment. They're both perceived as the same thing. They're not the same thing, but for our clients, we think they are, and that's how we understand they see some of these results. And then the other thing was, well, maybe we can go on this later. Yeah, on the resources used.
yeah.
Yeah, well, we will talk about this later.
Okay. About the
Resources used.
Okay. Yeah.
Yeah? Oh, sorry. Yeah.
So, okay. Let me let me continue the discussion. So, okay. So just I want to make a point that probably is very important. So this discussion really fit into the long-standing discussion, about the trade-off between social performance and financial performance. And there is another important point here, because I don't remember if the last year, a couple of years ago, I received a question from the public saying, okay, so you want financial institutions to generate impact, social impact. Now you want them to, to generate environmental impact and support clients in adapting to climate change. And now you are saying, okay, now we also want you to focus on the client financial health. The point is that the financial health approach is an overarching approach. So it embraces any type of social or environmental approach when we're talking about, financial resilience. So that financial resilience can be, either affected by health shocks, natural shocks, whatever. So it's a overarching idea. Well, the next question is about, okay, we measure, right? We are now adjusting products and services, but we may face several barriers, either internally, institutional barriers, so institutions that are reluctant to change their approaches, but also clients, because you want them to improve their financial health. For example, long-term savings, right? But then they are not, they do not take up the products, or they're not, their behavior is still the same. And then my next question is about how you have tried to address these issues and how these issues are actually prevalent in your experience.
All right. In terms of barriers to financial health measurements, if you haven't taken one of these questionnaires yourself already, I would recommend going online and just finding a couple. Take any financial health questionnaire off the shelf that you might find, and just page through the questions. Think about how long it requires you, as somebody in an audience like this, to complete those questions and who you'd like to share the answers with. I don't think they're that onerous as far as survey research goes. On the other hand, any kind of survey research about the well-being of clients, customers, members is always an investment. It's always an enormous amount of staff time, because we like to think about measurement at scale. We can do very small scale studies with a couple of hundred individuals, and we can put evidence forward about how customers are doing at a point in time. We can run impact evaluations where a question set on financial health is part of that evaluation strategy. But if what we're really talking about is measurement at scale, thousands to hundreds of thousands of customers, hundreds of frontline staff being trained on the implementation of the questionnaire, or distributing self-administered questionnaires, then the effort of measuring this really does, in some sense, have to be a priority for the institution. There has to be a strategy for managing that change and implementing that change throughout the organization, because most financial services providers did not do this from day one as part of their core business. So if there is to be an effort to measure financial health at scale, which I think is a very good thing, it does need to provide appropriate feedbacks to key stakeholders in the institution who can drive change forward and explain to frontline staff why this level of investment is necessary. Having said that up front, there are some trade-offs that we run into when we measure financial health. The complexity of the scorecard that we use is a barrier to people who are consumers of that data understanding what they're being presented with. So if I tell you that my financial health metric has a nice, easy to read 10-point score, You can get from a 0.0 to a 9.99 on my 10-point scale. And it just tells you whether you're doing poorly or well in financial health. But I used 14 questions, so I really like the way that this measures financial health for a large population. There is always a subset of users that are willing to spot you. You did some really good statistics here. We trust your algorithm. We know that there's a really good scorecard behind this, but I can't see what the point value is for question 3. At least it comes off the API really quickly into my user interface. So somebody gives me the answers to my questions, I have a very precise score for financial health. But there are a lot of other users that want to know something else. They really want to be able in the training sessions to unpack the scorecard and be sure that they're understanding how answers to specific questions feed into a final measure for financial health. And I think those things are in direct conflict. So one question that you're going to run into as you do this is, which metric do you choose? Do you choose the highest quality metrics that you can, that you think are predictive of an outcome that you care about? Or do you choose the ones that are the simplest to explain on the page, where everybody can sort of read what the scorecard says and know why points are being handed out? The kind of imaginary endpoint of that conversation towards simplicity is a very small set of questions that don't get aggregated into a score at all. But if they're not yes/no questions, maybe they're a 5-point Likert scale from always to never, or from totally disagree to totally agree with a neutral level in the middle. And the nice thing about those individual questions is that nobody needs to be told what it means. So we'll take just the one from the United States that we write about every couple of years when we do our triennial survey of financial well-being through the central bank survey. Could you manage an emergency $400 expense? Everybody knows what the answer to that question is. Yes, I could manage it. No, I couldn't manage it. Or it has analogs in lots of places. This is the resilience question. This is probably the most common question about financial well-being in the world that's been asked in slightly different ways with slightly different follow-up questions in a variety of contexts. But I would say what I've been able to see in the last 3 years of working on this topic, in particular over this period of time, is a trend toward not aggregating into scales or scorecards. More and more, the end consumers of the data really just want to know, what's the question that you asked and what did people say, so that the metrics are as simple as they can possibly be. The other thing that we've been doing is trying to use as much administrative data as we can to pair with the smallest number of questions that we possibly can, because if people are not being recruited to a survey or to a study, if they're just customers and you're asking them to provide survey data, it's critically important that the tool not be a 10 or a 14 or a 25 question survey. The completion curve looks basically like this when you administer surveys, and you're counting questions across and completion rates as you get beyond 3 questions. Anything outside of 3 questions, there's a subset of users that are totally happy to answer that set of questions. Majority of users will not stick around for a 4th question. And the reality of that is either it's frontline staff who are begging customers to take some time to submit the data, or it's end users who are happy to take the survey tool for themselves. The final thing that I'll say, which is a really common problem for financial services institutions, is the compliance function around submitting this type of information to your lender. And so you'll really want to be clear what the regulations are in the markets where you're working, whether it's ethical and whether it's permissible for individuals who are borrowing from a financial services institution to make this kind of disclosure about their financial condition to their lender. Under what circumstances and with what kind of personally identifying information that can be linked back to a customer profile. It could be a very, very good and an important tool for supporting your customers. And there's always a commercial imperative, especially where customers are what we refer to as thin file customers. There's always a commercial imperative for the financial institution to look for sources of information about credit quality. And unfortunately, the timeliness of repayment is both a critical component of day-to-day financial health, and also it's probably the primary component of most credit scores out there in the world as we find them today. So that's a challenge that your institutions will definitely encounter, and you'll need to decide how to manage that. Is there a strategy for managing it? How will it be managed? And what about the perception of that possible conflict from the point of view of the financial institutions members. Thank you.
So on our end, I think we share some of the challenges that BFA exposed, but I think that there are two other elements. So the one classical issue about measurement that you find in general in measuring outcomes, you'll find here, perhaps at an exponential level, because there are two elements, right? So the first element is the questions are asked at household level, and it's not that easy to answer a question at household level. You tend to have information and you want to link that information from household level to your MIS data, because it's not sustainable to have certain surveys with a certain complexity or length at a very long period of time. So we try to triangulate that data, so to combine the survey data with our MIS data, and currently we have not been able to find any sort of correlation, link, comparison, or even a client segmentation. We haven't been able to do that, which was our first target. Like, let's try and segment our clients to provide the right saving product to the right type of client. That didn't work. So that's one of the big issues that we find, and that's why we still do surveys. We're trying, again, as he said, also simplify the surveys, ask simpler questions, which leads me to my second point, which is some of the concepts in financial health, if we don't even agree on the definition, let alone our clients will agree on certain concepts. So one example, very simple example, is shocks, contingencies, emergency expenses. That's a concept that you would typically think, any of us would think, is a simple concept. For our clients, I mean, we did last year a survey, a very heavy survey with a long set of questions on contingencies. We had 10 types of contingencies. We explained it in a very simple way with telenovela type style training that we did to our credit officers. Our credit officers are very well informed. We do surveys on a regular basis. And even our own credit officers didn't understand the concept, because for them, an emergency is part of their day-to-day management of finances. It's not an emergency, really. They don't see the difference between the different types of emergencies. So that level 2 I was targeting, how do you manage emergencies, was basically, how do I manage when I just, my funds ran out today, right? So it didn't really work. I wasn't able to we tried to do a scoring system to say, listen, how relevant, how frequent, and therefore how intense is this shock, and how do you cope with it? But we weren't able to really get very, very good data out of that. It was sort of mixed, not comparable across countries, when typically in my data set, the conclusions tend to be very, 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 very common across countries. Yes, you have differences, but you've got a set of trends that are very, very similar across our client segments, because our client segment is very similar and our approach is similar. So I think that the concept of financial health is not well understood, and therefore the types of questions we ask and the responses that we get are not necessarily what we can use or what we would expect, or very useful to use on a day-to-day basis to actually design solutions, because that's why we're here, right? We're not talking about measurement just for the sake of it. We're talking about finding solutions to help our clients improve financial health over time. And that's just not that simple. It's quite nuanced and it's very complex. I'll leave it there for now.
Thank you very much. So let me just now give the floor to our online guest. Who's going to start? Andres or Meda, are you there as well? You go first.
Welcome, Angel.
Okay, great. Because we have to manage one by one, so yeah. Thank you very much. As I said before, Angel is the marketing manager of ICREMEX in Mexico, and they have been collaborating with the global BFA in implementing a financial health approach in their institution. And we'd like to hear about your experience in doing that. So how was your journey, and what results have you achieved? Thank you very much. Andres, you can go.
Well, thank you very much. Good afternoon. Good morning here in Mexico. Sorry about going before Meta. Thank you very much. Right now, our reality after the preview that Ben helped me to make this overview about the reality of measuring the financial health. We continuously strive to innovate and adapt our financial services to people's real needs. Our vision has led us to initiate a project to measure our clients' financial health. This by the hand with the BFA Global and conducting comprehensive studies about including this word that we have been mentioning around the panel today, the surveys. We have been working around with 5,000 people in Mexico, most of them clients, none of them clients. So this analysis has allowed us to understand the real financial situation and taking a better adapt for our products. Through this research, we discovered the importance of savings for our clients and how do they distribute their money in different ways, from keeping it at home or diversifying it among various financial institutions, following patterns that are meaningful to their needs. Then, here in Mexico, due to security concerns, people tend to be very protective of their personal information. Even when our own institution conducts financial health questionnaires, some clients remain skeptical about the authenticity of these information requests. To address this situation, we have implemented a strategy where our branches staff personally informs our clients about upcoming questionnaires of studies, which led us to build more trust or to build trust and allows our staff to be prepared so they can connect in a more security way with our clients. So they don't have this type of we will have a meaningful trust with them. So with this challenge, we have to purchase tablets to invest in more time for our staff, and we try first to conduct these questionnaires without any incentive to our clients. But we were having a little, well, we were having a lot of trouble coming up with all the information that we were looking for. So after we established a little incentive, we agreed to pay around is $2.50 to each person that answers this questionnaire. Everything changed. So we have a very good response from our clients and non-clients to respond to these questionnaires. Then having working with our data, how to leverage to design the products to improve our client outcomes, all the information that was collected from our clients, it has been analyzed by comparing it with our products. It's essential right now, allowing us to conduct a comparative analysis between actual usage and people's main financial objectives for maintaining a stable financial health. Our studies have revealed various savings patterns. Some clients keep money at home. Others make small family loans to maintain capital availability. And many distribute their savings among different financial institutions. This diversification responds to specific objectives for each portion of their resources. We, as a financial institution, we focus on financial education to help our clients optimize their savings, promoting consolidation into a single account to maximize returns. We recognize that many people don't invest due to lack of knowledge or fear. So we use social media to share educational videos where real clients share their investment experiences, generating greater empathy and identification with our audience. After identifying some of the issues, so we get new purposes, so to generate this new pathway for helping people to identify their saving goals. Um, in an inter way, we identified that in some of the savings, people doesn't have these measuring goals or these saving goals. So we have created educational material so we can demonstrate people what can be or what else can be their goals for saving. Because sometimes people they say no, I would like to save only for any specific purpose. But after making uh, to maximize this vision about saving, for people get a new reality about savings and a new purpose. So this already helped us a lot. So in numbers, currently over 11,000 people as our clients manage group loans in here in Mexico through our project with the MetLife Foundation and BFA Global. We aim to convert 60% of these clients into savers and investors. For this purpose, we have developed an educational materials, as I was telling before, so we can demonstrate our clients about the reality or what can be the real purpose or the goals they can achieve by saving. So, and getting into the end of my participation, thank you very much. As an institution, we focus on popular finances. So we're constantly open to implementing new technologies and sharing knowledge through workshops and talks. This allows people to develop a broader vision in their financial reality, understand how it affects personal finances and the uses of financial services. We believe that the biggest barrier is the lack of knowledge, as many people are unaware of the scope and positive effect that responsible credit use and consistent savings programming can have. Unfortunately, in Mexico, there is a perception that credit only serves to get into debt, and savings is seen as difficult to achieve due to the insufficient income. However, after these projects that we have been handling with BFA Global, we are able right now to establish different products or to change our products so they can adapt better to the reality of our customers. Something really important right now is that that we know about the costs. In the past, we didn't know about the real cost that affects our products. And right now, after all this, we are able right now to have a more clear idea what are the costs, what is the price of each product that can affect each person. So after all this, we can adapt that to the reality of people right now. So we're getting an advantage with our segment in market, so we can offer them more products that are more real for them. So after this focus of financial health, it has led us to get more evidence about the true health and the true meaning of financial reality for our clients. And finally, more after a cultural barrier, because right now in Mexico, we're focusing on the reality of savings in people. So as a general study right now, we're looking up so we can improve and we can change more things about in our products, and we can expand all these ideas, because right now we are working with people among 35 and 45 years old, and right now we're looking to work with young people around 18 and 25 years old. So all this will help us to get to know them more clearly and expand our mission. So thank you very much for your time.
Thank you very much, Angel Andres. I do have a question, but I'll leave it for the very last. Now we can move to Maida. Maida is the group CEO at Micro Loan Foundation. Can we switch? Yes, perfect. Okay. Um, Good. I'll give you the word immediately. Okay.
Okay, thank you, David. And a pleasure to be here and participate on this panel. As mentioned in my introduction, I'm the Group CEO of Microloan Foundation. Just for context, Microloan Foundation currently operates 3 microfinance institutions in sub-Saharan Africa, in Malawi, Zambia, and Zimbabwe. We're a credit-only institution at the moment, so we're slightly behind in the journey, I guess, in addressing financial health by providing a more comprehensive set of products, but we have started that journey. Our average loan size tends to be $65 to $80. We work 100% with women clients in rural areas in these markets, and we work primarily with the group lending methodology, just given the clientele we service. So that's just a bit of the context. And I'm going to perhaps reiterate or echo some of the sentiments shared by my colleagues on this panel. And I wanted to touch upon a few things. Firstly, when it came to sort of addressing what are the main challenges in getting data on financial health, practically there are a number of things that we see on the ground. One of the first things is the problem of getting accurate and consistent data over time. I mean, you've heard from everybody else, it's a complex measure to get right. It's also, we don't have many standardized ways of measuring this. And it's also about client perception. So sometimes when you're asking data of clients, they have a perception about, or they think they want to tell you what they think they want you loan approval, etc. So sometimes divulging information, sensitive information from a client's perspective is a little bit tricky. So we talked about this earlier, getting buy-in from key stakeholders, including the client. Education is really, really important. So sometimes the main challenges we're facing is really in getting a consistent set of data that's accurate, that we can analyze over time. The second challenge that we face practically is really the problem of compliance. Loan officers or client officers who are at the forefront collecting this information. When we look back at our incentives or structures, they're sort of incentivized on client numbers and perhaps portfolio quality, and they really don't see the value add of getting information relating to overall financial health of clients. And this can be problematic in data collection. I mean, there's a lot more resistance on the ground. Again, we come back to key stakeholders buy-in, because if there is a sort of broader goal from a financial institution point of view on getting financial health right, then all of the elements within that structure are able to gather the right information, and there's a greater degree of compliance around these things. And then lastly, I think the systems itself, this is something that we're currently on this journey, because our current systems, the MIS that we operate with, have limitations. And so it's about really integrating the data from these questionnaires on financial health to the data that's populated in the MIS, and how does that lead to better decision making at the institution level, is problematic. So we've had to invest a lot in our own technology, develop parallel systems that helps in this integration. I mean, this is of course costly and time consuming. So there is an investment involved, which it obviously takes time, to demonstrate results. But practically speaking, these are some of the main challenges that we see on the ground. I also wanted to touch on something. I think the other point was really, how do we use data to inform product design? At Microloan, we have a strong social performance management system, a team, etc. So we focus a lot on gathering client feedback through satisfaction surveys, through client exit interviews, through focused group discussions. An example of this would be during COVID, actually. It was a great time for us to develop this product, a digital savings platform for our clients, because they wanted a safe, secure way to save. Commuting was a problem, as it was everywhere in the world. And this was something that came about as a result of the pandemic, which is a positive thing. But once we developed this platform, which was designed for women illiterate clients, it had to be user friendly. You couldn't have a large amount of text on it, etc. Through the client feedback process, we realized that because we work in a group structure, actually group savings was something that the clients didn't prefer. They wanted more sort of an individual say. So we transitioned based on that feedback from group savings account to individual accounts, which gave clients a greater degree of agency. They had greater control and visibility about their savings. And that was a really key change that we designed in our product as a result of client feedback. And of course, this is something that we're constantly seeing with our existing group clients. Some of our clients have been with us for over a decade or more. And again, it's through client feedback that we're seeing an increasing demand for an individual loan product. Some of them have outgrown the group model. They have future aspirations to grow their businesses into small and medium enterprises, but we see a significant gap in the market, especially in the regions where we operate in Malawi and Zambia. And as a result of this exercise, we've actually designed an SME or an ESG loan product in Malawi, an SME loan product in Zambia, which enables these clients to transition from the individual loan from the group loan to an individual loan. In Malawi, we are increasingly facing climate shocks, both in Malawi and in Zambia this year. Southern Africa is experiencing the worst drought in history. So a lot of our clients are agricultural clients, especially in Malawi. Close to 70% of our portfolio is in agriculture. So this is a really good time to look at financial health from the client's perspective, from the institutional perspective, because it's really about questioning ourselves to say, are our clients able to cope as a result of these shocks? And we're in the process of developing a climate insurance product for these clients. And part of this, sort of adaptation to these risks is also having alternative sources of income for our clients. This has again come back to us as a result of the feedback and surveys that we've done and the focus groups that we've had, particularly in the southern province of Malawi. We're seeing increasingly clients saying, we want to be able to develop alternative livelihoods so that when there is a climate risk, we're not reliant solely on the agricultural income. So I think this feedback sessions with clients and these surveys have been really, really instrumental in enabling us to come up with more creative solutions for our clients in the face of all of these evolving risks. And I think we've started that journey as well. We participated in a good starting point was, we participated in the 60 decibels microfinance index for 2023. We were actually named as a top impact provider for Zambia in that index. And so that gave us a sort of well-rounded picture on the kind of questions we ought to be asking clients, in the form of resilience, agency, household impact, etc. And this is something that we look forward to building upon. Thank you.
Thank you very much, Medha. So now we want to hear from you, your reactions, your questions.
Yeah, I have a question for Angel, if he's still here. We heard alternatively from several presenters that asking these questions can create a better relationship with your customer because you're showing that you care about their financial health. And asking these questions can make your customers uncomfortable because you're asking for private data that they don't necessarily feel comfortable sharing with you. So I just wonder if you can talk about, on balance, what was their experience balancing that tension? Like, did it help them get closer? Did it irritate them? How do you manage that?
Thank you very much. Is there anyone else?
Thank you very
Oh, yeah.
much.
Angel, do you want to answer?
All right. Yes, thank you very much. At first, it was very difficult because our clients, well, the first approach was that we, like the normal way you send or you approach for a survey, we send a message through WhatsApp. Well, the first time was through SMS, an SMS message, and we sent a link. We say hello to the client. We give a little explanation around 20 words, and that was it. And we send the link. This was very bad. We didn't have. It was less than the 5% of the response of the 100% links that we send. So after this, we make some personal interviews with the clients that we send this link. So first said that even though the message says that it was from us, from Acreimex, they didn't feel secure to provide information or to give or to respond any kind of survey. So after this, we implemented, and they feel very how can I say, um, like violated, that we violate their personal space. Like, why are you sending me this message? And I know I know I'm your client, but why are you sending me this? So they feel very upsetting about this first messages that we send. So after that, we implement. We thought about maybe a longer path to get these surveys answered. So, but it will be reflected on more cost for us. But we said, all right, we have to do it. So if we want to get these responses or these surveys answered, we have to invest more. So this longer pathway reflect that at the very first time, we send the information to our branches, so they can attend by phone, by personal interview, by message to our clients, letting them know that we were going to send them a survey and that we were going to ask some type of questions. So in advance, we give all these messages to our clients, and after all that, this took around a week to inform our clients, 6 days, and then after that, we walk through managing personal links, sending through WhatsApp to our clients, and we were saying on the message, all right, as you already know, as your branch already informed you, we're going to, or we want to you to participate with us in this survey. So after all this path, we uh, we uh, we increase over the 52% of the responses, but we were missing around uh, these 48% of the surveys. So we were like, all right, what are we missing? So why people don't want to? So now why people don't? They do not want to answer the surveys. So after this, we have to invest a little bit more. So we gave our people an incentive, in not in cash. So we make to each people that answer completely the survey, and we can prove that in our system. We authorize by deposit around $2.50 to their accounts, for each person that answered completed surveys. And after this long path, after this incentive, we got over the 100% of people to getting to answer the surveys. So this was the pathways that we took. So we can right now, we have identified these pathways so we can implement for more surveys.
Thank you very much, Angel. I know there is...
Thanks, David. I'm Chris Zerwanka with Amarante Consulting. It's a pleasure to hear from Meda from MLF, who's a partner of ours that we've worked with on some of these projects, and also from Angel, who knows us in Mexico. I also have a company called Mosabi. We're doing things to try to make digital financial health scorecards understandable, digestible, and actionable for clients. And to follow up with Amelia's question, it's about the client interaction here that I'd love to query you guys. I've heard some great things about measurement and more consistency and best practices and ways to do that at scale, especially. But to what extent can we, thinking of the R and the A in DORA, resilience and agency, if I think about those words, I think about clients, and if they can access this information, see their scorecards, be able to answer questions like, okay, you're helping me understand my own resilience and that capacity. Well, what can I do to improve it? Is it just information that you're going to use to position different products towards me and find a better fit on your end or for your stakeholders or your investors? But agency. How can I seize more agency and get more value out of products? What benefit is it going to bring me with your products, the institution, but overall with my financial life? And I wonder if you might share a bit about that, about how more insightful scorecards and measurement can also be brought down to the client level and bring about some of that behavior change that I think I hear between the lines with all of you.
Hello, Alia from Al Majmoua, Lebanon. I just wanted to go back to the question of the methodology, because how to do the arbitrage between asking some kind of standardized questions so we can have a benchmark, but at the same time it's very much also contextual linked. And Colombia and Lebanon and many other countries have been going through very long crises. So sometimes what we find as regular questions are not really adapted. Thank you.
I think in terms of the client relationship and how to lift your clients up and use the measurement experience as one step on a pathway toward improving financial well-being or health. I think there's not a one-size-fits-all answer to that. It's a crummy answer, but you really don't want the yardstick to be confused with the fertilizer, right? Like if you're growing something, you want to measure how tall it got. You want to have a good measure that shows you're on track to succeed. Those things are important. You want to know what the interventions are and have it be applicable in a lot of different situations. So I wouldn't presume to say from my desk in Boston, I've discovered how to improve financial health in all the contexts that are present in this room, but rather to say measuring it all by itself won't make it better. Measuring it should be part of building a client relationship and a client journey that results in better financial well-being. But that comes up all the time in our collaboration with organizations just like ACRA-MX. I'd actually be curious to hear a lot more from Angel about how you build a customer experience that results in these savings patterns where it's not under the mattress, it's at the institution. The institution's MIS data have a higher wallet share for the individual customer. You really see what's going on with that customer. You convince them that one of the best uses of that capital is to put it in a deposit account with whatever purpose and whatever other kind of wraparound services go with that. As far as customizing, the calibration surveys are really expensive to run in comparison to measurement. My first question to Angel was going to be, if I had the question to ask, 50 pesos doesn't sound that bad for measurement. I do measurement all the time, and 50 pesos would be a lovely price point. But if we're talking about thousands or hundreds of thousands of clients, do you get enough in a commercial sense out of that relationship that the 50 pesos is worth it? The calibration study for financially marginalized customers It's really tricky to run, requires really smart people who are local and statisticians to work together to develop the right question set and metrics that are actionable. What do you think, Stephanie?
I'm sorry, I'm gonna go away from that slightly because, so very easy on the question side. There are a number of ways to simplify. For example, that's why I never ask about the saving balance. I ask about how many months you can survive, and that's something that's very contextual. And it's a very simple question to answer. Most of our clients would answer that easily. That's the first thing. The second thing is most of the local responses will be reflected in the response rather than in the way you ask the question. And if we can put up them slides, I can show you something that's one of the graphs that I put aggregate data. I can show you how that differs per country. So that's the second. The third would be, this one. And this goes a little bit more to, so for example, mistrust. So we ask what are the barriers for saving? And when you ask the clients, mistrust, for example, tends to be really, really high. It's 13% in Chile, in Peru. That's FC. FC is Peru. Sorry, yeah, this was my internal, so it's not adapted for, sorry. FC, so it's Banca Mia, is the first one, is Colombia, Peru, Dominican Republic, Chile, and Panama. And mistrust is one of the main barriers in Peru, which is, for those that know Peru, Peru is one of the most developed microfinance markets probably in the world, in terms of regulation, in terms of competition, in terms of size. It's a very, very, very mature market. And still mistrust is a main barrier for them to save with us and generally to have a financial relationship with us. So the local responses here, you see the differences, and so we tend to address that. Secondly, we spend a lot of time making sure the questions are piloted, tested, and we use experts when we need to. So we do spend a lot of time in thinking about the questions and finding parameters that are comparable across countries. So that's on the question side. On the behavior side, which is a difficult one, and I agree with you. So I'll give you a real-time example. BBVA Bank. So I'm the microfinance arm, but there's a bank as well. Typical retail bank, the bank we would bank with. I bank with BBVA. And that bank is present in Colombia and Peru as well. And they've developed a financial health index that's exactly what you're looking for. I can see my account now in my app and I see, oh, Stephanie, you've spent too much this month, which generally happens. You're not saving properly. It was a failure, a disaster. And their data is significantly larger in types of data points and also in quality and also in variety. So I'll never be able to compete with them, and it doesn't work. So people, the why it doesn't work, we can go into later. But generally, it doesn't. It's not a strategy that would work even for a more sophisticated, informed, healthy, stable person like I would be. It doesn't work in Spain. It didn't work, for example. In Colombia, it didn't work. So across the globe, BBVA implemented this strategy. It didn't work. Big failure. They actually purposely do not talk much about financial health because everything they've tried has failed so far. And this is just for purposes of this audience only. With our clients, let's keep it simple, right? Let's talk about our clients. I don't try to think about their behavior yet. I spend a lot of time, I think one of the good things about measurement is that we need to really, and that's something actually we discussed with Ben as well. And the example that he put earlier about not putting too much scores and things about that, because you want to be asking or understanding or interpreting the data in the right way and reframing the question that you're really asking yourself to solve the issue at hand. Let's take a real example, savings. Let's say that we're successful in financial health because all our savings balances increase. I serve 1.7 million savers. I have 1.7 million people that have a savings account in my three countries, sorry. 1.7 million is a lot of people. 50% of those are dormant accounts. I mean, any microfinance institution would be, I mean, if we're all honest here, you would agree with me, right? Operationally, everyone has that. Let's go one segment below. 23% of those are what I call transactional. So you've had a credit relationship with me, but your account is dead. I mean, you transact a little bit, but it's $3 here, $5 there, transactional. So there's potential for them to be savers, but shifting that behavior, very difficult. Another 25, let's be generous, 25% of those clients are what we call potential clients that could become savers or transaction clients. So they're clients that have a loan with me. For them to then save with me is a whole different story. I'm left with 5% of clients that have a deposit, that have a savings account with a target, all these products that we talked about where you have, very specific target, where you have training, SMS reminders, all the typical, best practices that we all learned about. I do those. 5%. That's 30,000 clients roughly. It hasn't changed over the last 3 to 4 years. Pre-COVID, post-COVID, I don't care. 5% that hold 81% of my savings balance. So some are big numbers. Some are institutional clients. I mean, they look like institutional clients, but I filter those. So they're retail clients, but with large amounts. Now I said, okay, listen, let's go to those clients that have very specific savings products and let's be very active and launch a campaign. Like, okay, let's go for it. Christmas campaign, great moment in Latin America to be very proactive for savings. You want to get great presents for your family. It's very cultural because again, financial behavior is very cultural as well. So we did this huge campaign for this very good product we had in Dominican Republic, which was very flexible because again, you have to be a flexible account. You can't have a deposit of 3 months that they can't access. Doesn't work with this segment. We had training, we had SMS reminders, and we had a target. And you could see the balance going from $1 to max $25, average $9 after 3 months. Christmas is over, it gets empty. Which is what happened in COVID. All those accounts we opened during COVID to give all those subsidies, the people got the subsidy and left, right? It's the whole point about CGAP saying we open accounts, but they're not used, right? And we did another campaign, and now I've got my CFO breathing down my neck. Like, what is going on? You're paying training, you're having my people launch campaigns for what, 200 clients with $25 max in your savings balance? Are you kidding me? And he's right, like what, he can't do anything with that. So I think, so now what we're looking at is, okay, let's use digital tools. And there's something there, I haven't found the solution yet, but a lot of my digital clients that have a savings account, they love, and this goes to the digital point, they love to upload their payment for mobile phones because they're chatty people. And so they save so that they can have the entire month of mobile phone working. Our WhatsApp works the entire month, but in Latin America, that doesn't work. 53% of my clients are digitally poor. That means that they're not able to either access the internet, stably access the internet, afford the internet for a month, blah, blah, blah. And we're trying to look in that way because we need to think, okay, what is my incentives? Their incentives, they're checking on a daily basis their account online. That's what they want their digital account for, to check their balance all the time. They manage their accounts on a daily basis, not on a weekly, not on a monthly. 3 months is long term for them. So we're trying to work there to improve savings. Savings for me has not been a solution that's sustainable, scalable, long term with deep impact. Not a solution. Insurance, however, that's flying. So yeah,
Thank you, Stephanie. I'm very sorry, but we are over time. Let me just wrap up a little bit what we have discussed about. So we said that taking a financial approach is very important. However, there are several challenges that we have to overcome. Measurement, going from measurement to the design of financial services and products, and then resistance from both internal into the institution and clients, right? And now this is these are many of the points that we have discussed within the action group. If you look at our materials, we also talk about the nudges, and different example cases of how to use nudges to push clients into more savings or to take up financial products or to use financial products properly. Thank you very much to Stephanie, Benjamin, Angel, and Maida. And I hope, thank you, Maida, Angel.
And a very gracious thank you to our organizers, Max and Davide, for putting today's talk together. Really
Thank you very much. And to all of you as well for participating. Thank you.